The rate cut looking increasingly likely at this stage?
Our expectations are that we will see a rate cut from the RBA next week. When you look at market pricing, it's saying a 97% chance that rates will be reduced next week. 25 basis points is what our expectations are. And when you look at things like that monthly CPI inflation, it really does strengthen the case for that reduction. I don't think any of us thought there was going to be back-to-back rate cuts, but I do think looking at that monthly inflation data, it really does support the move from the RBA next week. I'll be very surprised if we don't see that delivery of a rate reduction. Overall, I think Australians are playing catch up. I mean, when you look at borrowing capacity, it's nowhere near where it was when the cash rate was at rock bottoms or mortgage rates were at that rock bottom. And we've got to think that when you look at mortgage repayments and the cost of living, they're still higher than they were 5 years ago. And I think, Australians are feeling those financial scars. And I do think that we are playing catch up. And I think there is a little bit of cautious behaviour also coming in here around spending.
I was keen to get your thoughts on that, actually. Is it a bit of a behavioural thing, perhaps? Conditions might have eased a little, but households are still a bit jittery about spending that disposable income because, those days of higher inflation and interest rates, they're not too far behind us.
Absolutely. I think that we're all cautious now in terms of how much we spend. I think that there has been, obviously in our housing market, there's entrenched affordability issues also. And when you look at the share of mortgage repayment compared to income, it is extremely high and it has risen substantially over recent years. And that is because property prices have continued to rise. And I think those entrenched affordability impacts in our housing market are really having an impact. But there's also other things, you mentioned there about the behavioural side. Consumer sentiment overall is still negative. It has started to improve, but I think we have to look at the global impacts of the economy as well and think of the Trump tariffs and the disruption, global wars that are happening or the wars that are happening in Ukraine. And I think that is having an impact on sentiment also.
So what could all of this mean for housing? I've been reading, for example, a further cut in interest rates could help the construction sector, for example. Do you agree with that?
Look, I think the construction sector is still very strained. I think when they have labour shortages, higher construction costs, it isn't a silver bullet in terms of the reduction in cash rate. It will obviously help the financial balance or the financial viability of projects. We still have an undersupply of housing. And I think when you look at a reduction in the cash rate, this is where it does become very interesting for our housing market. Historically, when you see a cash rate reduction, obviously it improves borrowing power. And what that tends to do is bring people to market. It brings more demand. And what that can do is actually inflate prices. And what we tend to see when rates are reduced, we do tend to see that it puts a bit more of a spark, a bit more of a momentum in our housing market. So our expectations are that prices are going to rise. And we released our forecasts recently, and our expectation of prices are going to rise across all of our capital cities. But I think what we're expecting, though, is our bigger capital cities, our more expensive capital cities like Sydney and Melbourne, they tend to be more sensitive to changes in interest rates. And what you tend to find is a rate reduction is amplified through those housing markets much quicker compared to other capital cities. And that's ultimately because these are markets where households are really indebted. And those changes to the cash rate tend to be amplified quicker through those capitals.